All right, let's get right into it. For as long as any of us can remember, there's been one golden rule for investors. When the market goes haywire, you pile into the safety of government bonds, right? But what if that fundamental rule is about to completely flip? What if that safe part of your portfolio is about to become the epicenter of volatility? That's what we're going to dig into today. There's a massive event on the horizon for 2026, something called the debt wall, and it could completely rewrite the playbook on risk. So here's how we're going to break this down. First, we have to start with the risk-free foundation, that core idea that's held up the entire financial system. Then we'll look at how confidence started to get shaky. After that, we'll tackle the main event, the 2026 debt wall itself. From there, I'll show you the nitty-gritty mechanics of how yields can actually break your bonds. And finally, we'll put it all together and see why fixed income might just be the new volatility play. Okay, so first up, the risk-free foundation. Before we can understand why something might break, we first have to understand why everyone thought it was unbreakable in the first place. This is the bedrock belief of modern finance. And really, it all comes down to this classic quote from former Fed Chairman Alan Greenspan. He laid it out perfectly. The U.S. government has a superpower that no company and certainly none of us has. It can literally print the very money it owes. That means, technically, it can never default on debt in its own currency. So because of that superpower, U.S. government bonds, or treasuries, got this special title, the risk-free asset. Think about that. It's the global benchmark. It's the 0 point against which the risk of every other investment on Earth, stocks, real estate, you name it, is measured. It's supposed to be the safest place to park your money, period. At least, that's been the story for decades. So that brings up a pretty big question, right? If the U.S. can just print money, what could possibly be the problem? Well, this is where the simple story starts to get really, really complicated. It's not about the ability to print, it's about the consequences of having to print way too much. And here we have the first real jolt to the system. You had the old wisdom on one side, that U.S. debt is the safest thing out there, and then bam, a new reality. One of the big three credit rating agencies, Standard & Poor's, comes out and says, not so fast. They actually downgraded the U.S. credit rating. This was a huge deal. It was like the financial world's referee questioning the integrity of the game's most important player. Now, S&P didn't just do this on a whim. They had a list of reasons. They saw the political infighting that was making sound financial decisions almost impossible. They saw the mountain of debt getting bigger and bigger. They saw that the economy, the GDP, wasn't growing fast enough to keep up with that debt. And then there's the big one, this massive off-the-books IOU of over $100 trillion for things like Social Security and Medicare. It's a huge promise with no clear plan to pay for it. And to really get your head around the scale of this problem, you have to know about one key number, the debt to GDP ratio. It's simple, really. Think of GDP as a country's total annual salary, and the debt, that's its total credit card bill. This ratio tells you if your salary can actually cover your bills. It's maybe the single best snapshot of a country's financial health. And here's the number that's keeping people up at night. The U.S. is sitting at around 120%. Let that sink in. The total national credit card bill is now 20% bigger than the entire country's annual salary. If this were a company, the board would be in an emergency session. If it were your neighbor, you'd probably stop lending them money. This comparison really puts it into perspective. Look at the U.S. government next to a company like Apple. Apple is swimming in cash, has a stable outlook, and is considered AAA paper. That's the best credit rating you can get. The government, meanwhile, is running a huge deficit and has a negative outlook. Its only real advantage is that printing press. But S&P's downgrade was basically them saying, hey, just because you have a printing press doesn't mean your finances are in good shape. Okay, so we've got the shaky foundation, we see the cracks appearing. Now let's talk about the big storm brewing on the horizon. This is the main event, and it's called the 2026 debt wall. So what in the world is this debt wall? Well, it's not made of bricks and mortar. It's made of trillions of dollars of maturing debt. Think of it as a giant financial deadline, a moment in 2026 when a massive amount of old government borrowing suddenly comes due all at once. The name actually comes from the real estate world. Picture this. A developer builds a skyscraper in 2020 and gets a huge loan with a super low 2% interest rate. But that loan is due in 5 years. Now it's almost 2026, and they have to get a new loan to pay off the old one, but interest rates are at 6%. Their payments are about to go through the roof. That's a debt wall. Now, just imagine that, but for the entire U.S. government. And this is how the perfect storm came together. Back in 2020 and 21, the government went on a borrowing spree, issuing trillions in debt at rock-bottom rates. Then, to kill the inflation that followed, the Fed hiked rates faster than we've seen in 40 years. And now, all that cheap debt from just a few years ago is about to mature right in 2025 and 2026. Every single one of those bonds has to be refinanced, but at today's much, much higher interest rates. But wait, it gets even trickier. There's a huge plot twist. See, back when the government was issuing all that debt, its number one customer was the Federal Reserve itself. The Fed was printing money and buying up bonds like there was no tomorrow. That was quantitative easing, or QE. They were the guaranteed buyer. But now they've done a complete 180. With quantitative tightening, or QT, the Fed isn't just not buying anymore, they're actively shrinking their holdings. So right at the moment the US Treasury needs to find more buyers than ever before in history, its single biggest customer just got up and walked out of the store. So the government has to find a ton of new lenders. Big deal, right? Why should that matter to you or your portfolio? Well, this is where it all gets personal. We have to talk about the brutal math of the bond market and how that supposedly safe bond you own can actually lose you a serious amount of money. Seriously, how is this even possible? You buy a US government bond, you're told it's as safe as cash, and you expect to get your money back. But millions of people got a rude awakening on this recently. The market value of your safe bond can and did fall off a cliff. Okay, let's walk through exactly how this works. Imagine you bought a 10-year Treasury bond a few years ago that pays you a 2% yield. At the time, that was a decent deal. But now, because of everything we've talked about, the government has to sell new 10-year bonds, and to attract buyers, they have to offer a 4% yield. Now think like an investor. Why on earth would you buy my old 2% bond when you can get a shiny new 4% one straight from the source? You wouldn't. So the only way I can sell my old bond is to lower its price, to sell it at a discount. And the math here is just brutal. That seemingly small rise in interest rates can easily erase 10, maybe 20% of your bond's principal value. That painful reality is what we call duration risk. And I want to be crystal clear. This is not some abstract theory from a textbook. This is exactly what happened in the real world. This is the very dynamic that blew up Silicon Valley Bank in 2023. They were loaded to the gills with what they thought were safe, long-term government bonds. When rates shot up, the value of those bonds collapsed, it vaporized their capital, and it led to one of the biggest bank failures in US history. Okay, let's put all the pieces together. We have a government with worsening finances. We have a giant wall of debt coming due that has to be refinanced at much higher rates. And we have a bond market where those higher rates can cause real, painful losses. This, my friends, is a recipe for some serious volatility. And this is really the central point. The whole paradigm is shifting under our feet. For decades, the game was buy bonds for safety. But now, the game might be trade bonds for volatility. We could be heading into an era where the bond market, of all places, becomes the most action-packed, unpredictable part of the financial world. So if things are getting volatile, how do we spot trouble ahead? Well, the bond market has its own powerful storm warning system. It's called an inverted yield curve. It's a bit weird, but here's how it works. Normally, you get paid more interest for locking up your money for a longer period of time. But every once in a while, that flips upside down, and short-term bonds actually start paying more than long-term bonds. When you see that, it's the market basically screaming that it expects economic trouble right around the corner. And look, this isn't just some old wives' tale. The research on this, pioneered by Campbell Harvey at Duke University, is incredible. An inverted yield curve has shown up before every single US recession for the last half-century. It has a nearly perfect track record. And when the bond market is signaling a recession with this kind of reliability, the stock market usually isn't far behind in reacting. Which brings us to our final and maybe most important question. As we head towards this 2026 debt wall with massive borrowing needs, higher rates, and no more help from the Fed, we have to seriously reconsider what risk even means. Could it be that the single biggest risk in your portfolio is hiding in plain sight, in the very asset you always thought was the safest? And if that's true, are you prepared for the volatility that's coming?